Yeah, we were turning the corner, but now we're in the deep, dark depths of a full bore crypto winter. As you said, we have to accept it. It's here, it's chilly. Spring will come, but it's cold right now. But look, I don't think we're going to see the kind of heavy selling that we saw earlier. I don't think people are giving up on crypto. I think it is going to bottom.
Crypto markets have entered a phase that investors historically recognize but rarely welcome: a broad contraction in prices, liquidity, and risk appetite. What began as a correction has clearly transitioned into a full risk-off environment, with capital rotating defensively, volatility rising, and sentiment deteriorating across both Bitcoin and the wider digital asset space. What stands out in this downturn is not simply the magnitude of losses, but the internal divergence within the market. Assets with sustained institutional flows have demonstrated relative resilience, while large segments of the retail-driven market have absorbed severe drawdowns. This is not random price behavior. It reflects structural differences in demand, capital stability, and investor positioning. Matt Hougan, Chief Investment Officer at Bitwise, addresses this environment with a notably disciplined framework. Rather than debating whether crypto is in a winter phase, he focuses on why the downturn unfolded the way it did, how market mechanics amplified the move, and which risks remain relevant. More importantly, he outlines the emerging narratives that could ultimately define the next expansion cycle. Because even in contractionary periods, underlying adoption trends continue to develop. Stablecoin growth, tokenization infrastructure, and the integration of AI-driven financial activity are not short-term price drivers. They represent potential long-term demand engines. Understanding this distinction is critical for investors navigating volatility. If you value structured, investor-focused analysis, you're in the right place. Like the video, subscribe to the channel, and let's examine Matt Hougan's breakdown of the current crypto market cycle.
Matt, what was the factor that made you finally accept this reality, I guess?
Yeah, it was actually a chart, believe it or not. So the real story behind the scenes is I was preparing a chart on the market for Bitwise's corporate board, which I do each quarter just to give them an update on where things are setting. And I plotted the 10 largest crypto assets starting in January 2025. And you saw Bitcoin and Ethereum sort of trundle along for the year. We remember Bitcoin ran up to 126,000 and ended the year down 6%. Ethereum a little bit worse, but it wasn't bad, a modest pullback. But as I looked at everything but Bitcoin, Ethereum, and XRP, it was down only starting in January 2025. And when you looked at assets that had no institutional support, like Avalanche, Sui, Cardano, et cetera, they were down 60 or 70%. What hit me is that is a full-blown crypto winter. So there were sort of like two classes of assets. There were assets that had ETFs where institutions were shoveling money into the fire, and those ended the year down 5 or 10%. And then there was crypto retail, and those assets ended the year down 70%. And it all of a sudden clicked to me. One of the things we discussed late last year was the duality of crypto's personality. I was saying institutions are really bullish, and the fear and greed index was like a 12, and crypto retail was really bearish. It turned out that they were just in two completely different market cycles. Crypto retail was bearish because the bear was out. It was already winter, assets down 70%. We just didn't see it in institutional land. And it made me realize that crypto winter was here. It then took down Bitcoin and ETH, right, in a major way, because eventually spread. But it was really that chart. It was just stark to me. If you didn't have ETFs, you were already down 70. And that's a dark winter. There's never a monocausal explanation. It's always multiple straws that break the camel's back. I think the conditioning straw, the big one, if you were span out over the last year, is OG selling to exit in front of the 4-year cycle. I think that is the biggest. That was the one that I led with. But in terms of what sparked it on a practical basis, why that day, I actually think it was a general risk-off trend in the market. So I think all the things that I added up before then, OG selling, quantum risk becoming a concern, the October 10th leverage overhang, rumors in the market were there. And then the match that ignited the spark was other assets pulled back, right? Software companies pulled back, gold pulled back, silver got crushed. And that just was enough to push it over the edge where everyone was like, I'm not touching this thing, let it burn. And that's how you get a $10,000 down day. And people are trying to point to like some hedge fund that was unwinding. There's talk of it's always an offshore hedge fund that no one knows, but an offshore hedge fund that was unwinding a complicated position and was a forced seller in the market. That may be true on the margins, but I think without all these preconditions, I think really what happened is 100% of buyers evaporated. All the buyers stepped out of the market. There was still selling. Maybe there was a little bit of forced selling, but when there are no buyers, when there's no bid, it can just fall off the map. And there was no bid. Everyone was like, quantum fears will get worse. Fears about Kevin Warsh will get worse. The market is going risk off. AI is going to destroy all profits. Companies won't live for more than 5 years. There's like an apocalyptic sense. And I think it was just buyers vanished. So I think it became a one-sided book and the price just fell into a vacuum. I think the biggest risk is people will disagree with my view that this crypto winter started in January. And they'll say quite reasonably, I'll say, I argue that it may have started in January. They'll say quite reasonably that no, it started in October, Matt. And the average winter is 13 months. So talk to me at Thanksgiving. I'll buy then. I think that's probably the biggest risk to the market. I know that's unsatisfyingly reflexive, right? Like the market will go down because people think the market will go down is like a 6-year-old analysis of crypto. I just happen to think that it's probably true in this case. The other risk that I actually think many of those other risks will turn around. So I think quantum will turn from a headwind to a tailwind. I do think the Bitcoin community is now listening on the quantum risk. I think developers are doing calls on the quantum risk. I wouldn't be surprised to see some sort of roadmap or chatter emerge in the next few months that becomes a positive. I think on the Kevin Warsh side, I think he's probably going to surprise to the upside on the rate cutting expectation. And I think the Treasury will do all the money printing it needs to do effectively, and he'll be somewhat constrained there. So I actually think maybe the negative Warsh impact is at a bottom and is going to turn around. I think the biggest risk is still just people assume the winter will last 13 months, started in October, call me in November and we'll bottom there. It's possible that happens.
It's a self-fulfilling prophecy until it's not, right? I feel like that's the most. Everybody saw that weird like 4chan post in early October that was like, here's the amount of days and the amount of days of bear and bull. And it was like, there's no way some obscure internet post could possibly be right. And it was spot on for the top. It's like, there's no way all of this is that simple. And yet it feels like it's like, maybe it is until it's not.
It absolutely is until it's not. I think people like me over-intellectualized the market at the start of 2025 and said it's going to be institutionally driven. And the factors that drove the 4-year cycle in the past are no longer as true as they are today. And that turned out to be incorrect. The institutional part was correct. Massive inflows, $75 billion of inflows into ETFs and corporations and Bitcoin alone last year. It's just, as you mentioned, $100 billion of selling by OGs, and that's a bigger number. So yeah, sometimes it's as simple as it is until it's not. Again, I'm not sure that it's right because I think the winter may be a little long in the tooth. We do have the lowest fear and greed measure in history. We got down to 5, which is, if you think about that, it can go to 0 or it can go to 100. That's a pretty asymmetric skew. So maybe we're closer to the end than the beginning. That's my optimistic take. From an investor perspective, maybe it's a good time to dollar cost average in. I wouldn't be trying to pick a precise bottom and assume we're going to V back up.
Hougan's explanation of the downturn cuts through the usual market mythology. Rather than attributing the collapse to a single dramatic trigger, he highlights a layered reality: structural selling pressures, shifting liquidity dynamics, leverage imbalances, and a broad risk-off environment converging at once. Most striking is his observation of the market split, institutional-supported assets displaying relative stability while retail-driven assets absorbed devastating declines. In essence, parts of the market were already in winter long before the broader narrative caught up. More importantly, Hougan challenges the reflexive search for a villain. Not every collapse requires a hidden hedge fund or catastrophic event. Sometimes markets simply lose their bid. Buyers step aside, uncertainty compounds, and price falls into a vacuum. That framing matters because it shifts focus from conspiracy to structure, from drama to mechanics, which naturally leads to the next critical question. If winter is here, how much further can it stretch, and what does the eventual recovery actually depend on? Let's return to Hougan's perspective on selling pressure, market psychology, and the conditions required for a durable bottom.
Do sellers still have more in the bank to offload? And where would we go from here if we were continue to go down?
Yeah, my basic view, having spoken to some, but obviously not all of the OG crypto investing community, is they're not excited about selling at these levels. The flip side is, I hate to be the bearer of bad news, they're probably excited to sell again at 100,000. So there may be some overhead when we get back into that range. But look, I don't think we're going to see the kind of heavy selling that we saw earlier. I don't think people are giving up on crypto. I think it is going to bottom. It tends to bottom in exhaustion, to use your word, and apathy. It doesn't sort of bottom in excitement. So maybe once people stop paying attention to crypto is when it's going to be a great time to buy. But it is a behaviorally driven asset. And I think that is just objectively true. We are humans. I think, I don't necessarily mean that we'll bounce our head off of it and come back down. I think that will be context dependent. So in other words, if we have a rip-roaring equity risk-on market, if the Clarity Act passes, if Warsh actually cuts rates more aggressively than people expect, if Japan stimulates the way people expect, if China's M2 continues to grow at the rate it's been growing, I think that's enough catalyst that we could push back and actually go to new all-time highs. If we have a more modest series of developments, if the S&P 500 is middling along, if Warsh doesn't do anything when he takes over, if the Clarity Act fails, then I think that $100,000 will be a pretty hefty head for crypto this year. So it's really context dependent on where we go.
So you wrote also this great piece. It's titled Crypto's New Narratives, and it really summarizes a lot of the stuff that you discuss on our shows in terms of where crypto's going. Take us through this a little bit for people who maybe haven't read it.
Yeah, sure. I mean, part of what I'm doing here is, giving you a view of the long-term positive drivers, but also reflecting what I hear from the smartest people in the industry, what they think will sort of lead the market out. I could just go from the top. I think that first piece on revenue is a pretty big one. We've been tracking the revenue that blockchains generate very closely. Blockworks is a big leader in this space. They have some great dashboards on it. The industry is currently churning at about $7 to $8 billion in annual revenue, but that has the potential to skyrocket if the things we mentioned below, like stablecoins and tokenization, go up. I think part of what will lead crypto out of this bear winter is more real world use. Some of the other things that I called out here, which are worth talking about, AIFI, which is a term that makes some people sort of choke in their mouth, but is a term that I've heard recently. But by that I mean that there's this huge boom in AI agents. I think it was hard for anyone to keep their eyes off Moltbook or whatever it's called these days. But if you think of the world in the future of having billions of AI agents operating on our behalf, they're not going to go to the local Wells Fargo branch and open a bank account. They're going to use crypto and DeFi. And actually, they don't even care that DeFi's UX is imperfect. For them, it's perfect because it's rules-based digital logic. And so I think that is a huge driver. That actually may be one of the big narratives that comes into the next cycle. And then there are all these good pieces of news that we just forget when there's a bear market. You have Ray Dalio effectively saying that fiat currencies are dead. You have strong institutional adoption, right? We had all the major wirehouses approve Bitcoin ETFs in the last 3 or 4 months. We do have strong regulatory progress. We have stablecoins that the Treasury Secretary says is going to, $3 trillion. We have tokenization, which could be hundreds of trillions of dollars. We have Vitalik returning to ETH in the Steve Jobs moment. There's a lot to be positive on. If you think about back to previous bear market cycles, what sort of led us out of those bear markets? If you go back to 2018 and 2019, it was really the emergence of DeFi and DeFi summer that gave us a new thing to focus on. If you go post FTX, it was really the hope for an ETF and institutional adoption that gave us a new thing to focus on. I think there are all these many positives underneath the surface, but it's easy to imagine what we focus on in the rest of 2026 and 2027. We focus on stablecoins, super cycle. We focus on tokenization really taking off. We focus on agentic finance, or AIFI, if you can stand the term. And we focus on institutions coming into the space. That's like, those are really good catalysts. I've heard all this chatter. There are no more catalysts. What are you talking about? Stablecoins are 300 billion. They're going to 3 trillion. Tokenization is 20 billion going to 200 trillion. They're the catalysts. They're just apparent. We just can't focus on them right now. Fast forward 5 years from now, and imagine you're like, well, of course AI agents are using DeFi and stablecoins. What did you think they were going to use? They were going to use bank accounts? Like, it's completely ridiculous. Like, it sounds absurd sitting 5 years from now to imagine that AI agents aren't primarily transacting over blockchain-based networks, over digital finance. I do think that's, and it's not something that's broadly discussed. So I think as that narrative becomes broadly discussed, you could have that be the equivalent of DeFi summer a few years ago. I'm not saying it's definitely true, but there are a number of major crypto VCs who believe this is the direction of travel. There are early signs in the agent universe that this is how they're actually interacting with the world. I do think it could be one of the narratives that lift us, not the only one.
One of Hougan's most valuable insights is behavioral rather than technical. Markets rarely bottom when optimism returns. They bottom in exhaustion, in apathy, in the quiet phase where participants stop debating narratives because they've emotionally disengaged. That observation is deeply consistent with historical cycles across asset classes, not just crypto. Equally important is his framing of overhead resistance. The idea that long-term holders may become sellers again at psychologically significant levels like $100,000 isn't irrational, it's human. Markets are not governed purely by valuation models. They are shaped by memory, anchoring, regret, and risk management. Ignoring that reality is costly. Understanding it is strategic. But where Hougan's analysis becomes particularly constructive is in distinguishing cyclical pain from structural evolution. Winters end not because prices magically rebound, but because new demand drivers emerge. In prior cycles, those drivers were DeFi, NFTs, and institutional ETFs. The next phase may be defined by something far larger. Stablecoins are quietly becoming systemic infrastructure, not speculative instruments, but settlement layers. Tokenization is not a crypto-native story. It is a capital markets transformation story. And the integration of AI agents with blockchain-based financial rails introduces a future where machine-driven economic activity directly interfaces with crypto networks. If that trajectory continues, demand for digital assets could become functionally embedded into technological systems rather than purely investor sentiment. This is the distinction serious investors monitor: price cycles versus adoption curves. Short-term volatility remains unavoidable. Winter conditions may persist longer than participants prefer. Resistance levels may cap rallies, but structural narratives are not weakening. They are compounding. And historically, markets tend to reprice aggressively once those forces become impossible to ignore. The investors who navigate cycles best are rarely those who predict exact bottoms. They are the ones who correctly identify regime shifts. If you found this breakdown valuable, like the video, subscribe for more investor-focused analysis, and share your perspective in the comments. Are we closer to the end of winter, or still early in the storm? Thanks for watching.